What's good, everybody? Welcome back to the B23 Financial Academy. We hope all of our videos have found you well thus far. This video will be focused and based on the Fibonacci retracement tool that can be found on your MC4 platform or on TradingView. It'll be an introductory video, and then in video 2, we'll do live chart examples. Basically, we're following the same format that we do for all of our videos. Theory first, and then live chart analysis. So on the screen, you have, the title, obviously, and then you have these 1, 2, 3, 4, 5, 6 lines representing the Fibonacci. You have 100, 61.8, 50%, 38.2, 23.6, and 0. 100 and 0 don't count as Fibonacci levels. They're just there to help you identify where you start to plot your Fibonacci and where the end is. So 100 and 0 are not Fibonacci numbers. They're just there to guide you when you plot the Fibonacci on your charts. The key numbers to focus on are 61.8, 50%, and 38.2. I don't really regard 23.6 as a fib level or a key level. It's there, but I don't regard it as such. So what is the Fibonacci and what is it used for? Basically, the Fibonacci tool is a tool that gives you a chance to re-enter the market if you missed the first move. So let's say, for an example, you had price moving up like that. Okay, let me just do this quickly. Let's say this was some sort of, okay, hold on. Let's say this was some sort of support, right? Price did something like that. There was some sort of support structure here. So then price shot up. So now you missed the initial move or the first move here at support or at this double bottom or at this W. If you've watched the previous videos, I'm pretty sure you understand what I'm saying. You missed the first move up. So now you want to catch the reversal or the retracement. Basically, let's just assume that the change in trend has occurred. Please go back and watch our videos on market structure and the changes in trend. They're very key and vital to the Fibonacci. Let's assume we had a change in trend somewhere here. So now we are expecting upward movements. We are expecting a bullish trend to start. You missed the initial move up. So you want to enter when the market reverses. So now the market does something like this. We know that in an uptrend, price will make higher highs, higher lows, higher highs, higher lows. So the market does something like that. The Fibonacci tool gives us potential levels where we can enter. I'll explain it in detail again now. For example, we have 61.8, 50%, and 38.2. This level where price reversed at here could have been a 61.8 reversal level, could have been a 50, could have been a 38.2. That's the function of the Fibonacci. It gives us potential re-entries when we missed the first move. So I think I should just type that here as a note. It gives us re-entry Okay, the Fibonacci retracement gives us potential re-entry possibilities when we missed the first move up or the initial move up. I think that will be fine. Or let me rather do this. And then I think I'll just change the color to red. Yeah. Okay. The fib gives us re-entry possibilities when we missed the initial move up. So let's say we couldn't buy here, or we were busy with whatever. For whatever reason, we failed to buy here. Price has changed the trend. We know it's going up. So we want to enter on the reversal or on the higher low. This would be the higher low in an uptrend. It would also coincide potentially with one of these three fib levels. So that's how we would go about using the fib retracement. Excuse me. The same is true for a downtrend. I'll make that example now, but let me just finish here. So let's say we had a change in trend somewhere here. Price made a higher high, then it's dropping to form a higher low. We want to enter on the higher low, right? So one way we could go about it is on the high low, we would look for some sort of reversal candlestick or some sort of support coinciding with the fib level. But live chart examples will be done in video 2. This is just the breakdown of how it works. It gives us, or the function of the fib is to give us potential re-entries when we missed the initial first move up. Let me just do a bearish example quickly. Just give me a couple of seconds. Let's clear this out. If what I'm saying doesn't make sense now, just wait till video 2. It'll make a lot more sense. Only if you've watched the videos on market structure and if you understand the changes in trend and the breaks of the high, low, lower high, and all of that. If you don't and skipped those videos, you're going to have a problem. Just advising you. Okay, let me do a similar thing. Say now there's some sort of, hold up, let me just do this properly. Say now there's some sort of double top formation or resistance, right? There's resistance and then we have something like that. We are assuming price has broken the lower high. Wait, is it the lower high? No, I'm lying. The high low. Price has broken the high low. The change in trend has occurred. We missed the initial move down. We couldn't enter here for whatever reason. So now we want to enter at the reversal or at the retracement. Reversal and retracement and pullback are basically the same thing. We know that now we have changed the trend, so we want to enter when price reverses, hoping that the market will continue to go down, which it probably will if the trend has truly changed. Again, all you would do is you would plot your fib, and then you'd either enter on 61.8, 50%, and 38.2. All of these levels have different meanings and market terms to them. I'll just type them in here on the right. But this is basically how you would go about using it. How you'd plot it, I will explain in video 2. So I hope what I've said or explained makes sense. And then I'll just explain what these different levels mean in most cases whenever the market touches or bounces on them. Just give me a second to erase this. All right, so we have 61.8, 50%, and 38.2. The most significant fib level is 38.2 because it 38.2 indicates strong momentum or a strong trending market. I'm disregarding 23.6. I don't really use it. I've never seen the function or the use of it. So I'll just leave it on here, but just know that we don't really use it. This is for 38.2. Whenever the market touches or bounces off 38.2, this fib level, it usually indicates strong momentum or a trending market. And then 50% is just normal. Normal momentum. And then 38.2, not much momentum. There's actually a trick to these fibs. 50% of 50 is not as significant as 61.8 or 38.2. Even though the market bounces at 50%, it's not as heavy or it doesn't carry as much weight as 61.8 or 38.2. Whenever the market bounces on 61.8, you could potentially have a stronger trend compared to price bouncing off 50. Even though 61.8 is not as strong as 38.2, most times it is stronger than 50. I know it's quite confusing. I'll explain it on the live charts, but your notes should be centered or focused around 61.8 and 38.2. You can use 50. It is a fib level, but it's not as significant as these two. This you can completely disregard. This is just there to help you plot your fib. So the way you plot your fib is from the lowest point to the highest point, but let me just stop the video there and I'll explain that in video 2. Please leave a like on the video, subscribe if you're new. It's been Mr. B23 signing out.